Hey folks, today I'm diving into a crucial economic indicator that impacts us all, the GDP annual growth rate. It's a measure of the percentage change in a country's gross domestic product over a year. In simple terms, it tells us whether an economy is expanding or contracting. So why is this number so important? Well, a positive growth rate means economic expansion. This usually brings more jobs, higher incomes, and better living standards. On the flip side, a negative growth rate suggests a recession, which can mean job losses and lower consumer spending. By keeping an eye on this metric, governments and businesses can make informed decisions. Now, what drives changes in GDP growth? Several factors come into play. First up, consumer spending. This is the largest part of GDP in most economies. When people have more disposable income and feel confident about the future, they spend more, which boosts economic growth. Next, investment by businesses in infrastructure, technology, and equipment. Favorable economic conditions and low interest rates often encourage this kind of investment. Government expenditure also plays a big role. Public spending on things like infrastructure, healthcare, and education can directly impact GDP. During economic downturns, increased government spending can stimulate growth. Then there's net exports, the difference between what a country exports and imports. A trade surplus, where exports exceed imports, boosts GDP, while a trade deficit can drag it down. Technological innovation is another key factor. Advances in technology improve productivity and efficiency, leading to higher output and economic growth. Plus, it creates new industries and job opportunities. And lastly, demographics. Population growth and workforce participation rates also impact GDP. A growing, productive workforce drives economic expansion, while an aging population might slow it down. But interpreting GDP growth isn't without its challenges. It doesn't account for income inequality, environmental degradation, or the informal economy. For instance, a country might have high GDP growth, but significant portions of its population could still be in poverty. Also, GDP growth doesn't measure well-being or quality of life. It's purely about economic output. Globally, GDP growth rates vary. Emerging economies like India and China often show higher growth due to industrialization and urbanization. In contrast, developed economies like the US and Germany tend to have slower but more stable growth. Events like the COVID-19 pandemic can cause significant fluctuations in GDP growth worldwide. In conclusion, the GDP annual growth rate is a fundamental measure of economic performance. It provides insights into a country's economic health and trajectory. But remember, it should be considered alongside other indicators to get a comprehensive understanding of economic conditions. By addressing its limitations and focusing on inclusive and sustainable growth, we can ensure that GDP growth benefits everyone. Thanks for watching. Don't forget to like, share, and subscribe for more insights into the world of economics.